So Elon Musk recently asked Cathie Wood a very important question. What does she think of the unusually high ratio of the American stock market to the economy? Or in other words, does Cathie Wood think the stock market is overvalued and is due a drop? Or does she think it will keep rising? So in this video, we're going to be hearing Cathie's answer to this important question, along with a recent video clip where she goes into more detail on her thoughts. I'm also going to play devil's advocate and pitch the opposing argument to what Cathie believes, as I think it's important for us investors to hear both sides of the story. Hi and welcome back. My name is Tom Heavey. I hope you're doing well. If you enjoy hearing about investing and innovation, be sure to subscribe for weekly videos just like this. Okay, so let's get straight into it. Elon Musk recently asked Cathie Wood, what do you think of the unusually high ratio of the S&P market cap to GDP? So Warren Buffett has this way of judging whether the stock market is overvalued or undervalued, and it's so simple, you're gonna love it. So you take the total value of the stock market and you divide it by the size of the economy. So in this case, that would be taking the S&P and dividing it by America's GDP. This is what Musk was referencing in his question. And if we look at this chart, we can see something very interesting begins to emerge. Drawn right in the middle of this chart, this is what Warren Buffett calls the fair value of the stock market. This line basically tells us roughly where the stock market should be valued. Now in 2000, during the dot-com bubble, we can see that the chart peaked at 67% over this fair value. Not long after, the stock market crashed all the way back down. So what this chart tells us is how overvalued or undervalued the stock market is according solely to the fundamentals at that time. And that brings us to today. As we can see, the value today is higher than ever. The stock market to GDP ratio is 226%, which is 82% higher than the long-term trend line. So understandably, Musk is seeing this, as are many investors, and they're asking the question, doesn't this mean the stock market is surely due a correction? If it's overpriced today, then it must surely be on the verge of dropping. However, Cathie Wood doesn't think so. Instead, she responded to Musk by saying GDP statistics evolved during the industrial age and do not seem to be keeping up with the digital age. Thanks to productivity, real GDP growth is probably higher and inflation lower than reported, suggesting that the quality of earnings has increased significantly. So, what does Cathie Wood mean by this? Let's break it down. So Cathie is basically saying the real GDP growth is higher than what is being reported, and inflation is lower than what's being reported. Now, real GDP growth is a measure of a country's economy when you factor in inflation. So let's say, for example, a country's GDP rises by 3%, but inflation is also 3%. Well, those numbers effectively cancel each other out, meaning the real economy simply hasn't grown. So real GDP is where we take into account inflation, and that's what makes it the most important number. In the past, Cathie has talked numerous times about how the 5 platforms of innovation that she's investing into are falling in cost. In turn, that reduces prices that the consumer, people like you and me, have to pay, and so it's effectively a deflationary force. Now, the counter argument to this, of course, is that with the amount of new money that has been printed and the fact that the economy is beginning to open back up more and more, which should drive the velocity of money higher, well, with those things in mind, inflation is likely to pick up in most areas of life. Even if technology drives down some prices, other items are going to rise in value, which leads to inflation. It's really an interesting debate, and you can argue either way. But what's far more interesting is this clip where Cathie shares her thoughts more extensively why she believes the stock market is not in a bubble.
We are getting all kinds of questions about how sustainable what we're experiencing in the equity markets, in the global economy. How sustainable are these new mega trends that seem to be evolving? And I think what's great about Big Ideas is even we spend all of our time in the research and investing around these ideas. And even we, at the end of the year, as we're summarizing how big these ideas are, we are sometimes stunned when we pull away at how quickly this is happening, so quickly. And the other question we face here is this a bubble? Now, there's a lot of muscle memory around the tech and telecom bubble and bust. And obviously, that was not a good experience for a lot of people. It was their first experience with this notion that the internet, in that case, was going to set off years and years of exponential growth opportunities. And that did happen. It actually happened. But it did take, for some of the technologies, it took 15 to 25 years for the seeds that were planted during the tech and telecom bubble to bear fruit. Now we're ready for prime time. They're bearing fruit. Now that we're here, investors are skeptical. They're afraid that there are going to be disappointments like we experienced back then. Well, back then what happened is too much capital chased too few opportunities too soon. The costs were way too high, and the technologies were not ready. In fact, some of them didn't even exist. And so, of course, that did end badly. Now, the costs and the technology are at the right point so that we are experiencing exponential growth trends in 5 technology platforms involving 14 different technologies, individual technologies. And what we're seeing, which this is what is astonishing to us, I think, as we talk about this, we're seeing more and more convergence between and among the technologies. And so we're seeing one S-curve feeding into and accelerating another S-curve upon another S-curve. And I think that's why this is happening so quickly.
So Cathie makes the point that people are scared we are in a bubble today because they remember many of these new technologies coming online 20 years ago during the dot-com bubble. And back then, investors got ahead of themselves and started throwing money at anything with promise. Well, today, that promise is beginning to come true, and people might now miss out on these opportunities because of their fears of history repeating. So, is Cathie right or is she wrong? Well, the argument in favour of Cathie is one which is pretty convincing. Cathie and a team at ARK only invest into technology when they believe it is on the verge of disruption because the costs have fallen to a level which means the technology can be adopted. At the end of the day, it doesn't matter how promising a technology is, if it costs too much, it simply won't be used. And with all technology, there is often a specific range of prices where everything changes. So let's take electric cars, for example. Let's say the cheapest we can make an electric car is for $1 million. That's far too expensive and it won't be used. It doesn't matter that the technology is real, it costs too much. Now, as the technology improves, let's say the costs drop by 50%. That's a big drop, but still at $500,000, it's still too expensive for mass adoption. So even though the price came down by 50%, it still didn't have much impact. Now let's imagine we're many years in the future and costs are instead $40,000 per car. If the costs the following year drop by 50% down to $20,000, that would be a game changer. Adoption might be high at 40,000, but it would explode at 20,000. So when it comes to technology costs falling, there are often many years where the price is dropping, but nobody cares because it's still too expensive. This is what Cathie is saying has been happening with these technologies for the past 20 years. But now we're approaching the important thresholds that really matter, where the costs are dropping right into the sweet spot for mass adoption. Using Wright's law to calculate these falling costs, Cathie makes a very valid, very believable argument. And listen, I'm personally a fan of investing in innovation. That's literally what this channel is all about, and it's my passion. I'm also invested in ARK as well. So yes, I am biased, but I do agree with Cathie. However, as investors, we should consider both sides of every argument. Even if we don't agree with them, it's important to look at other perspectives too. So I've already talked about the Buffett indicator as an example to show how the overall stock market could be overvalued. Now let's get more specific and talk about ARK, because Morningstar Strategies recently penned a report and described ARK as below industry standards. Green Gold said that as ARK Innovation's size has swelled, it has become less liquid and more vulnerable to sharp losses. ARK has retained and grown its stake in small companies that are now much more difficult to sell without materially impacting their stock prices. In fact, across all US domiciled funds, the ETF stood out in February for having the most concentration in companies in which it owned 10% or more of floating shares. So over the past few years, Cathie has gone from a relatively small investor in the context of Wall Street to pretty much the face of high growth investing today. With that, ARK has not only grown the value of its investments, it has also had more and more money flowing into the ETF. As a result, they are now managing a huge pile of money. So they can either spread their money between more companies, or they have to buy larger and larger portions of the companies they're already invested into that they love. So essentially, because they've grown so big, it does mean that they now own a large portion of the companies they're invested into. And so they can't easily sell their positions without causing a big crash in the prices of those companies. It's true, there's simply no way around it, as ARK have grown larger and larger in size. ARK Innovation is in the red for this year, amid the recent rotation out of technology names and into value stocks from the pressure of rising interest rates. During this rotation, Wood has stayed the course, and ARK has often bought the dip in any of its top holdings. However, Green Gold said ARK's approach to risk management is almost exclusively done through the lens of its bottom-up stock research, which puts its strategy at a disadvantage relative to its peers. There is very little consideration given the portfolio's aggregate risk exposures. So I have to disagree with this point. Cathie has said on numerous times how she believes deflationary forces will mean that long-term interest rates will stabilize around 3%. And so rising interest rates today, in her opinion, are not such a major threat as many people claim. Clearly, she isn't just researching individual stocks, she has considered the overall stock market too. But here's the thing. When it comes to the stock market, for every analyst claiming it's going higher, there's another who thinks a crash is coming. For every analyst saying growth stocks will fall, there's another who thinks they'll rise. Now, Cathie has a pretty sensational record of calling things correctly in the past. She's made some pretty outrageous predictions about Tesla and turned out to be spot on. She was talking about Bitcoin well before any mainstream investor, and she's been right about so much more. So if anyone deserves to have respect put on their name, it is Cathie Wood. However, there's an important point that many investors overlook. If you believe Cathie is right, you still shouldn't put 100% of your money into her ETFs. That is not a good strategy to protect your money in case of a downturn. But likewise, if you believe Cathie is wrong, you shouldn't invest 0% either. That has the exact same flaws with it. As investors, we basically have to be humble and acknowledge that we can research as much as we like, but we can still be wrong. So if it's not 0% or 100%, how much should we invest in ARK? Well, as I'm not a financial advisor, I can't offer any specific guidance. Thankfully though, ARK penned a report a while back where they simulated 3 portfolios. One had a 10% allocation towards innovation, i.e. towards ARK. The next portfolio invested 15%, and the most invested 20%. So the range of numbers that they themselves used were between 10% and 20%. Remember to subscribe for weekly videos on investing in innovation just like this. Do you agree with Cathie or do you disagree? And how much have you invested in ARK? Let me know in the comments below. Thank you for watching. I will see you again very soon.